Did you receive more than $600 through Venmo, PayPal, or Cash App? If so, you might owe some taxes, even if it was just from family and friends. And here's the thing, the IRS probably already knows about it. So stay tuned because I'm going to be breaking out exactly what's going on and who's going to be impacted. And most importantly, what you need to do to be able to avoid unnecessary taxes. All right. So for years, the IRS has struggled with a massive tax gap. All right. So it's basically the difference between how much tax is actually owed and how much is actually being paid. And one of the major contributors, especially recently with the tax gap, is unreported income, specifically going to be from freelancers, gig workers, small business owners, people who have side hustles, who accept payments through third party apps like Venmo, PayPal, and Cash App, but they fail to report that on their income tax returns. And traditionally, many of these individuals were able to fly under the radar because the payment processors were only required to report transactions if a user received more than $20,000 during the year and had at least 200 transactions in the year. And this meant that there was a whole bunch of transactions out there, especially from smaller scale people who are doing part-time gigs and just casually making money on the side. They were able to go ahead and do this unreported, untaxed. But as digital payment platforms became more popular, the IRS started taking notice. So with the rise of the gig economy like Uber, DoorDash, Fiverr, Etsy, Airbnb, major sources of income for millions of people around the country, it became a bigger issue. And many people were not declaring that income. So the IRS actually estimates that hundreds of billions of dollars in taxes go uncollected each year due to underreporting. So they decided to take action. So originally, the IRS's plan was a $600 rule. And you may have heard of this. So this was like a $600 reporting threshold to be able to crack down on underreporting. And Congress passed a provision in the American Rescue Plan Act of 2021, lowering the threshold for third-party payment processors to just $600 per year. So meaning that any individual receiving more than $600 in total payments through Venmo, PayPal, would have their earnings automatically reported to the IRS via what's called a 1099-K tax form. And this new rule was originally set to take effect back in 2021 during that tax year. But after a huge backlash from taxpayers, businesses, lawmakers, the IRS decided to delay its implementation twice. Okay, so once in 2022, and again, they pushed it back in 2023 to give payment platforms and taxpayers time to be able to adjust to this new rule. So what they did was they created a phased out rollout, easing into the new rules. So recognizing that there's challenges with actually enforcing the $600 threshold overnight, the IRS decided to do a gradual phase-in approach to be able to allow taxpayers and platforms time to be able to adapt. So here's the new thresholds and how they're going to be rolled out. So for 2024, the tax year 2024, the reporting threshold is $5,000. So if you receive more than $5,000 in payments through these third-party payment apps, you'll receive a 1099-K from the payment platform, and the IRS is going to get that copy as well. For 2025, the threshold drops to 2,500, and for 2026 and beyond, the original 600 threshold will fully take into place and go into full effect. So that means by 2026, even if you're doing side hustles and not making a ton of money, you're still going to receive a 1099-K if those incomes and if those payments go over $600, making it much harder to be able to avoid reporting or avoiding reporting that income when it comes tax time. So what does this mean for you? So if you receive payments through platforms like PayPal, Cash App, Venmo for goods and services, you should expect to be scrutinized by the IRS in the coming years. And while these rules don't necessarily create a new tax, they do increase reporting requirements, making it easier for the IRS to detect underreported income and be able to flag for potential tax evasion. On the flip side, if you use payment apps for personal transactions like reimbursing your friend for dinner or receiving like a birthday gift, for those payments are not going to be taxable. However, because the IRS relies on this automated reporting now, there's going to be an issue now to determine which one's going to actually be for personal transactions and which one's actually going to be related to business and which one should actually be classified as taxable income. which is why it's crucial to be able to categorize these payments correctly. So ultimately, these new rules are going to aim to ensure greater tax compliance, but they also introduce some new headaches for taxpayers who are now going to have to be extra careful when it comes to how these transactions are going to be recorded, and more importantly, how they're going to be reported. So who's going to be impacted the most with all of this? So it's going to be a couple of people, like I mentioned, freelancers, gig workers, small business owners, right? If you provide services or sell products and get paid through Venmo, PayPal, Cash App, or other third-party platforms, you're going to be directly impacted. So whether you're a graphic designer, a writer, a photographer, a personal trainer, a tutor, a consultant, any other type of independent worker, these payments are now going to be tracked and reported. If you are online seller or reseller, so let's say you sell products through digital marketplaces like eBay, maybe Etsy, maybe Facebook Marketplace, and you receive payments via third-party payment apps, you're now going to receive a 1099K if you surpass and make more than those reporting thresholds that I mentioned. So that includes everybody from people flipping sneakers, furniture, other goods for profit, selling handmade crafts and collectibles, digital goods. If you run an online store and accept payments through Venmo and PayPal, all of these categories and all these people are going to be impacted by this, right? Even if you're a social media influencer, right? If you earn money through TikTok, YouTube, Instagram, Twitch, right? And receive tips, payments, or sponsorships through Cash App, PayPal, or Venmo, those earnings are not going to be considered taxable income for you. And they're most likely going to be automatically reported to the IRS, which means that you also are going to have to report it on your tax return. So there's going to be some people who are going to be excluded from this as well, or some situations that are going to be excluded from this. So let's talk about those. So personal transactions. So if you use Venmo, PayPal, or Cash App only for personal transactions, like maybe you're splitting a bill for dinner, maybe you're reimbursing your roommate for rent or utilities, maybe you're sending someone money for their birthday or as a holiday gift, then you're not expected or not going to be affected by this, right? So these transactions should not be reported on a 1099K. If you're selling personal items at a loss, right? So if you sell any used personal property for less than what you originally paid for it, it's not going to be taxable. So to give you an example, let's say you're selling a TV, a TV that you bought for $1,000 and you sell it for $400, or you're selling a couch that you bought for $500 and you're selling it for $200, right? Then those are not going to necessarily be considered taxable for you, right? So one thing you got to keep in mind, though, is the payment processor will still probably issue you a 1099K, making it look like you earn taxable income. But if this happens, you just want to make sure you classify that on your tax return to be able to avoid being taxed incorrectly for it. So another exception as it relates to this is going to be transactions through Zelle. So because Zelle transfers money directly between bank accounts, that does not necessarily hold funds. It's not going to be classified as a third-party payment processor. You will not have to issue a 1099K. However, if you're using Zelle for business transactions, you're still required to report that income on your tax return. So why is this important? Why does this matter? So even if you think this doesn't apply to you, it's important to double check how you receive your payments. Many people unknowingly mix their personal and business transactions on their payment apps, which could trigger a 1099K that they were not expecting. So bottom line is this: if you earn income through these platforms, it's best to make sure that you're keeping clear records of your business and your personal transactions. You want to use separate accounts for business payments. You want to track your expenses to reduce your taxable income. You want to report your income properly to avoid IRS issues as well. Also understand this when it comes to the 1099K and the IRS being able to monitor this. So there's going to be a huge issue. So when it comes to this 1099K is a tax form that's going to be issued by these third-party apps, right? Like I mentioned, Venmo, PayPal, Cash App, Stripe even. So when these transactions exceed the reporting threshold, like I said, for 2024, it's going to be 5,000. For 2025, it's 2,500. And for 2026 and beyond, it's going to be that 600 amount, right? So it's important to understand this because now if they go ahead and send out this 1099K, the IRS is going to receive that, and the IRS can now flag your return for review, issue penalties, and even trigger an audit if they wanted to. All right. So the gross amount of those transactions processed through a third-party payment are going to include all of the above transactions that I mentioned before. So it's really important to make sure that you're documenting this and reporting this correctly, right? If not, then you're probably going to hear from the IRS. They're probably going to may send you a letter, usually what's called a CP 2000 notice, asking for explanation of why didn't you report this. They may try to have you pay additional taxes, penalties, even probably audit your whole tax return, and much, much more. So it's really important to make sure you're doing this the right way and making sure that you're properly recording your transactions. So if you have any questions on this, let me know. And I look forward to seeing you in the next video. Take care, and I'll see you there.